I suspect that you being right about this is not really good news necessarily. But where are we right now in your estimation in inflation? It's certainly not up at the 5 or 6 number level, but it doesn't look like it's getting down to 2.
Look, it's always a mistake to overinterpret 1 month's number, and that's especially true in January, where calculating seasonality is difficult. But I think we have to recognize the possibility of a mini paradigm shift. The soft landing paradigm with the assumption that inflation was headed down to 2 in a tranquil, healthy, real economy has certainly been called into question by these data. There had been a strong assumption that housing was headed towards being a major deflationary force. That doesn't show up in these numbers on owner-occupied housing. And as I've looked carefully at these numbers, I think there's good reasons for that. The idea is that when we judge the cost of owner-occupied houses, we try to estimate what it would cost to rent the residence in question. And many people have done that by looking at all rentals. But most rentals are apartments, and those don't have much to do with the price of owner-occupied housing. If you look at the data focused on single-family housing, houses with lawns in suburbs and the like, you don't get nearly as deflationary a picture. The model I've been using for several years now with my co-authors at the NBER is still looking for 3–4% owner equivalent rental inflation through the remainder of this year. That's 30% of core CPI inflation. If it's running at 3.5, that uses up a lot of the room there is under a 2% inflation target. I think the Fed is going to have to be very careful. They were never right to be focused on March for a cut. I had been saying that seemed premature, and they and the markets have come around on that. I think that May is odds off at this point and probably should be odds off. And gosh, I think we've got to recognize what no one's talking about. There's a meaningful chance, maybe it's 15%, that the next move is going to be upwards in rates, not downwards in rates. You know, to use a metaphor, David, that I used to use on this show, the worst thing you can do when the doctor prescribes you antibiotics is finish part of the course, feel better, give up on the antibiotics because you don't like taking them, and see what happens. The disease tends to come back, and it tends to be harder to go after the second time. And interest rates elevated to contain inflation are like antibiotics. So I think the Fed has to be very careful in this environment. And I think that many people who confused what they wanted with what was real were in much too much of a hurry to declare that we were obviously in a phase of major easing with respect to monetary policy.
So, Larry, let me continue your analogy to a disease, and perhaps what we have here is we're not recovering fully to 2%. On the other hand, the fever's not spiking up to 5, 6, 7% the way it was before. What happens if we have just a low-grade fever at the 3+ level? What does that mean for the economy?
Gosh, Chairman Powell has said so many times, 2%, 2%, 2%. As you'll recall from our previous conversations, I didn't think it was a great idea to have had so specific and tight a target. But we've had one, and we've set it, and we've repeated it a large number of times. If we decide that 2 sort of has lost its meaning and it's not something we have to accept when there's strong political pressures to ease. If we send that signal, I wonder why anyone would believe that we're going to stick with 2.5 or 3 or whatever it is that we settle into. And then when that feeds into expectations, it'll get harder to hold the level we have. And of course, we are headed into, David, as populist election period as you or I can remember in our lifetimes. And we usually think of the Fed as a bulwark against populism, not as a reinforcer of populist pressures.
Let's continue on the subject of that populist election, as you call it, and specifically with respect to fiscal policy. You and I have talked before about the deficit and the debt that is mounting here. I know you've just helped launch something new called the Tax Reform Project. And in the introduction to that, you talk about that issue of the debt and the deficit, but it's somewhat of a new approach. There are a lot of people who have tax policies, but we haven't heard from the practitioners.
Yeah, so I'm supporting my former student and wonderful colleague, Natasha Sarin, at the Yale Law School, who's the driving force. She's focused on IRS reform, and we're focused on IRS reform just to enforce the tax law we have. And there was important new research showing that, from the IRS, showing that if we're able to carry through on the $80 billion program that was part of President Biden's Recovery Act, that can pay off 10 to 1 in $850 billion of revenue collections, in addition to making our tax code fairer. And that's where tax reform discussions should start.
And finally, Larry, there's a lot of talk about commercial real estate, particularly in the office space area. Obviously, the increased interest rates and failure to return to the office on some parts is really putting pressure on the valuations. So clearly, there are some people who are hurting because of the reduced valuations. But my question is it a matter of individual banks, for that matter, as well as owners being hurt, or is there a potential for a more systemic problem here with commercial real estate?
I think that this is something that our central bank is right to be looking at, and right to be looking at with an awareness that almost always in the past we have acted too slowly to force banks to stop distributing capital, to force banks to raise new capital where that's appropriate, to force banks to fortify liquidity. I think it would be much more productive for our central bank to be focused on the question of real estate portfolios in the banks they supervise and what the genuine value and creditworthiness of those assets is. I think that would be a much more productive focus for the Fed than some of the more abstract and politically driven arguments about various kinds of capital charges on the largest banks. The second set of arguments is an important one to have, but I think it's less urgent than the first.